Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today. Gosh, as always, we got great topics to make you a smart investor. Going to kick off the topics with big bank earnings. Give a cautious green light on the economy. So important when those come out. We'll talk about what the banks are seeing. Also, too, understanding new legislation on cryptocurrencies that happened last week. We'll talk about that. And then what is better for investors? Stock dividends or stock buybacks? We'll discuss that and give you some pointers on that. Chase, what do you got for companies?
Companies we're going to take a closer look at today includes Union Pacific, the railroad there. We're going to also look at TOST, and then meme stocks are back in the news. Had a few different ones this week, and one that I would say was the least meme-ish of them is going to be...
Least meme-ish?
Least meme-ish, yeah. I made up my own word there. Is going to be American Eagle. Maybe there's some opportunity there. I kind of did a sneak peek into the numbers, so we'll take a closer look, see if there's any opportunity to maybe join the meme crowd on that. And the last one's Abbot Laboratories. So as always, we'll look at the fundamentals, give you an idea of what we think on the valuation ratios. We think it's buy, sell, or hold based off the numbers we see.
All righty. Well, let's talk about big bank earnings. Give a cautious green light on the economy. And every quarter, we get pretty excited about listening to and reading about the things, what banks have to say in the most recent quarter as they release their earnings. I'm primarily talking about JPMorgan Chase, Bank of America, Citigroup, and Wells Fargo, the four big ones. We've had a couple large banks in our portfolio for years, and they have provided very useful information along with great returns as well.
That's so funny because we always talk about, it's not, tech. And I'm going to steal a little bit, I guess, from our portfolio. You look at like a JPMorgan Chase over the last, its performance is amazing. I mean, it's done so well. So, I mean, you can still do well outside of tech and different businesses is what we always look at. And in particular, when we looked at the most recent earnings and kind of listened to conference calls from these big banks, I mean, they were happy with the fact that there were low rates of consumer delinquencies, and the amount of debt they wrote off as unrecoverable stayed around the same as last year. And I'll point out, that was a good level.
Yes, very good level. Yes.
It's like, it stayed about the same. At a terrible level, that's not good news, but at a low level, it's good to see. And we've talked about this, but one banker made a comment that with a 4.1% unemployment rate, it's not likely to see a lot of weakness in their portfolio. And, we continue to think that as the employment situation remains strong, I just think the economy should do well. People, if they're making money, they have jobs, they have incomes coming in, about that debt out there, you should be able to pay off that debt, or at least make the payments on the debt. There are always going to be people that over leverage themselves, unfortunately may lose their job. But as a whole, I still think we're in a good spot. And it irks me when you hear, the economy's not doing well because of, student loans. Student loans are such a small piece of the puzzle. Even auto loans, you hear that one more frequently as well. Auto loans aren't doing well. To me, I don't want to say it doesn't matter, but it's not like the mortgage crisis because it's such a small piece compared to how big mortgages were. Too, mortgages are 30-year loan. Auto loans are generally like 5-6 years, and it's on a depreciating asset, so it's not going to cause the same type of catastrophe that the mortgage crisis did.
And the reason we get excited about this is because we've been talking about this, but when the banks come out with confirmation, and again, and your credit cards are generally the first thing people stop paying on. Yeah. You said that's about the same as last year, the debt. So that's fine. I mean, this is why we look at these things, because you can always find somebody like, it's very difficult for them and so forth. Of course it is. But as a whole, we have a very big economy. You have to look at all the population and say how it's doing. That's why we love reading what the banks have to say, because each quarter it's that nice update on the consumer.
And banks can't lie. They can't say, no, we didn't have any bad loans.
Right.
Now, they might fabricate how great things are, but generally bankers don't do that. So I think it is, again, a good reading.
And they can't say something like the rate was the same as last year.
Yeah.
They cannot lie on that.
They can't lie about that.
Can't lie about that, no. So, but another thing too with banks, they do deal making, and for the banks, it looked pretty good across the board, and all of them had profit increases compared to 1 year ago. Again, profits are up for the banks in deal making. The overall tone from the bankers was largely upbeat. A couple of banks did call out some concern around commercial real estate and office buildings, but the big thing, and we've talked about this as well, there are certain cities with economies that are doing well, but then there's some cities that aren't doing so well, and that's where the commercial property is not doing well. But banks have a diversified portfolio across the whole country. So if you're looking at where to invest, and we use a real estate investment trust and property, we picked one that is just in the strong areas.
Yeah, and I think it's important, again, when we're talking about the large money center banks, they're generally not going to have over-concentrate in certain areas, but we talked about the REIT, but if you're looking at a bank, if you're looking at, let's say, a regional bank, maybe a smaller regional bank, if they're not in the right areas, their loan portfolio could have some issues. So just kind of one thing to separate. Here we're talking about large money center banks. There's not going to be a portfolio concern because they are so diversified across the country. And again, looking at these details, I'd say the banks as a whole, they felt pretty darn good about where things are at, but they still remain somewhat cautious. And I got to say, that's how bankers operate. You listen to Jamie Dimon, he always talks about risk. And a banker should always be concerned about risk because not everything is going to be perfect. But, people always pull out Jamie Dimon says the economy is going to crash. And then you go look at it and it's like, he assigned like a 10% chance to it. And those aren't real numbers. They're just kind of fabricated based off what he said in the past where everybody pulls the bad thing, but then you actually listen to the details. And he's like, well, yeah, he's just assigning a probability to that. There's always a chance we tip into a recession. But you have to consider the worst case scenario and plan your business around that. Because if we go through a recession, you want to make sure that bank can stay strong, not just for a shareholder's perspective, but also as a citizen of America. You want to make sure these banks are okay because we know how bad things were in 2008, 2009 on the brink of collapse there.
Yep. And I just love listening to Jamie Dimon. I have my favorites that I listen to on the conference calls. And Jamie Dimon, he's just so straightforward, no hype, no hiding things. It's just straightforward. And I always look forward to his conference calls. A few other companies we have, I just look forward to. I can't wait to hear what they have to say.
Yeah.
So let's talk about understanding the new legislation on cryptocurrencies. Came out, last week. On cryptocurrencies, and it was announced as a Genius Act. And I always wonder, do they come up with a name of the title and then fit something to it? Or do they come up with Genius Act and say what will fit into that name? Because they always come out with something for it that has that. But the Genius Act stands for Guiding and Establishing National Innovation for U.S. Stable Coins. Now, it's made its way through Congress to the president's desk. The legislation now is supposed to provide licensing and oversight for stable coins as issuers now must attain licenses through either a national bank charter with the OCC, and OCC is the Office of the Controller of the Currency, or they can go to a state-level money transmission license. I've never heard of that before, but I guess I go to the state. That worries me because then you're not going to have the same regulation across the states. I kind of like the federal one better. I want all the stable coins to be. Yeah, I know. We could ask and want, but it's just like it's not going to happen.
Yeah, I mean, the other thing I look at too is it is supposed to provide consumer protection in the case of the issuer of a stable coin becoming insolvent. The solution in the Genius Act is to prioritize stable coin holder claims, so the holders of those coins should be able to get their money back. Keyword there. Should. This is nowhere near the safety, obviously, that one has in a bank where your deposits are insured by the FDIC should that bank fold. Again, we talked about this last week a little bit, but I just don't know why you would go into a stable coin when, again, you can just do a money market.
Yeah.
It doesn't make sense to me. And again, we'll have to see the use cases, I guess, as they unfold, but right now, I don't know why I would take that risk.
Yeah, and again, we talked about Jamie Dimon. He had something similar, like, well, yeah, we can use them, but I think he's thinking, I think we can do better and save money in the transmission of. I mean, so stable coins are just the buzzword. It's just a transaction that you're kind of working with, and it just it just worries me because everything's stablecoin. Reminds me back in 2000, everything was .com. Now everything's cryptocurrency, stablecoins. That's usually a sign that worries me. I do believe this law will give people that false sense of security, and I don't believe will prevent a major collapse of coins, stable coins. Let me repeat that. It will not prevent a major collapse of stable coins. There's also a conflict of interest from President Trump's promotion of digital currencies, since he himself has a coin, I think it's called the Trump coin, and this was amazing to me. His son, Donald Trump Jr., and Eric Trump, they run a Bitcoin mining firm called American Bitcoin. And the whole family is heavily involved in cryptocurrencies. And it kind of rubs me the wrong way that the president, and I don't want to get too deep into politics here, you should not be able to enhance things that, and write legislation on things. And I do think they're going in the right direction, trying to make it safer for people. It's still nowhere near safe, but it's still something that I think he should not be in, or his family should not be benefiting from crypto if you're making legislation on it.
Yeah, I mean, I agree. I think it's wrong. And especially something that really is only hype. I mean, if you have a company that's producing earnings and stuff, at least then you're able to kind of derive value from it. But I mean, shoot, you keep hyping it up, you could push Bitcoin to $200,000.
Yeah.
And it's like, wow, we're profiting even more because we're able to push up the price of it by just generating the hype. So I don't know. I think just personally, I think it's wrong. I think there should be some type of legislation that at least monitors and put some guardrails in there for politicians and, direct family members that can't benefit from it. But obviously, I don't write the laws, so I don't have an impact yet.
And I think there was some pushback in Congress on that a little bit.
Yeah, I think so as well. I mean, obviously, the left is not happy about it, and, I can see why.
and I did write my congressman saying I don't think this is right either.
Yeah.
I mean,
Yeah, so we'll see. But the thing that I look at from an investment standpoint is that I really just believe all of this hype surrounding it is just continuing to fuel this cryptocurrency bubble. And the important thing to keep in mind is that you guys have been saying Bitcoin isn't a good thing for the last 5 years. I mean, a bubble in theory can last 10, 12 years, maybe even longer. But the bigger and bigger it gets, talked about this before as well, the larger the financial disaster it can cause. And I just worry. I mean, right now it's like, I forget what the cryptocurrency market is. Let's say it's a few $1 trillion. And not overwhelmingly disastrous at this point since it is a global scale. But I mean, that thing builds up to 5, 10, 15 trillion. All of a sudden you have an 80, 90% collapse in it. From that point, that causes financial ruin. The bigger that bubble gets, again, the bigger the problem in my viewpoint.
Yeah, same thing. I was on KUSI News last week, and I get on, it goes, well, you were saying that Bitcoin was bad 2-3 years ago. Are you still sticking to that? I go, definitely. Nothing has changed other than the demand has come in, the hype has come in. And it went up tremendously. And as we say, it could go to 200,000. I mean, no one knows where this craziness will end, but it will end because there still is nothing backing it up. And I even heard President Trump today talk on a news conference saying that, we want, a strong dollar. It's different from me saying a weak dollar. But, people say, oh, the Bitcoin's going to replace the dollar. He's not saying that. So that's why it's kind of conflicting. Well, President Trump, do you want a cryptocurrency here, or do you want the dollar? He knows you have to have the dollar to run the economy. And that's why I keep saying that. Economies around the world, they do not want cryptocurrencies because they will lose control of their economy, and they cannot have that. You would have recessions worse than the Great Depression of 1929.
Yeah, and I would say the only benefit I see to stable coins is it does actually help with the borrowing rates because it fuels demand for treasuries. One of the things that they can buy is short-term treasuries. So that is the only benefit I see at stable coins at this point, is it could cause a higher demand for short-term treasuries, which in essence would push rates lower because more demand, more buying, that pushes rates down. So, I mean, I'd say that is the only benefit that I see at this point in time, but I still wouldn't be buying one. I don't see the point of it. We'll see. People might think I'm silly for saying that, but I just don't like to take chances on something that really haven't been proven yet.
And also, too, we talked before, and I think we said this. I think it was 2022, and that stable coin actually crashed. And there's two different.
I think it was Tether.
Tether, is that what the name of it? There's two different types. There's one that is backed by collateral for each. They have a fiat dollar, fiat currency behind them, backing it all up. Or the logarithms, where it kind of moves it a little bit differently so it's protected. those are the ones I think are the riskiest. But we still don't understand, like, and I guess they get, one thing I was thinking about too is that they get the interest at 4%. Now, say that next year, short-term rates are down, they reduce rates, and now short-term rates are 1.5%. What's the benefit of having the stable coin for that issuer, that custodian that's doing that? There's no benefit to it.
Yeah, I mean, we talked about Circle last week. That's where a lot of this conversation was had, and that's where most of their profits is derived from, is interest from buying the short-term treasuries. So as you said, if that interest rate goes down, well, now their profits go down. I mean, is that a company you'd want to hold? Probably not.
Yeah, I mean, we get a 4% on a money market. I'm sure that's what they're getting, maybe a little bit more. But that gets cut in half to 2. That could wipe out their profits. So
50% decline.
Yep. Be careful of stable coins. Let's talk about what is better for investors, stock dividends or stock buybacks. There's really no hard or fast rule based on performance figures in terms of what is better for stock investors, but I would have to lean towards stock dividends. If you look at the right companies paying dividends over a 10-year period, we'll call it, you can find that perhaps the company you invested in that was maybe yielding 2 or 3% when you bought it, well, now it's giving you maybe a 7 to 8% yield based on what your initial investment was. There's some benefits here.
I mean, you look at, I'm just going to pick on the 10-year treasury. Well, you buy that 10-year treasury for 4% to make things simple. That's all you'll get for 10 years. They don't increase that. That's your interest. But again, those increasing dividends are a great benefit. And again, dividends can be that really great tool for long-term investing. And it's important to point out, companies could always stop the dividend, but most companies that have paid a dividend for a long time don't like to stop or even reduce that dividend, as it could cause concern from shareholders. Now, you want to make sure you buy companies with strong financials so they don't have to cut that dividend, because that does happen.
Yep.
So you got to make sure you're buying good, sound businesses with good, strong cash flows to pay out that dividend.
And I'd recommend, if you're doing that, to make sure you look at the dividend payout ratio, look at the cash flow, look at the free cash flow to make sure that company can pay the dividend, and in worse times. Because if you're paying out 95% of your dividend, you hit a slow time, which is going to happen, you might have to cut that dividend, or I don't even talk about borrowing to pay the dividend. I never like doing that. But a problem with stock buybacks, we'll talk about that, can be announced. The stock buyback can be announced, and then the stock may maybe sees a little bounce. But then it's possible that management does not fully commit to the buyback of all the shares that they had planned to. Also, if the company or the markets were to hit rough patch, things pull back and so forth, many times the first thing that they stop doing is the stock buybacks. They would still keep paying the dividend, but we can't do that stock buyback because, we have a slowdown in business or the economy.
Yeah, and another thing I look at too is it's possible the company could do a stock buyback, but then with a year or two, that stock might drop below the price where the purchases occurred. That then is a waste of capital. It's like you would have been better off, obviously, holding it in cash than buying your stock at a higher level. So, I mean, there's this kind of point where you're like, well, I mean, if you're buying your stock back, it better be a good opportunity, because you can always use that capital to go elsewhere. And I'll pick on the dividend, let's say, as an example. I would have rather had you pay me a one-time dividend than have you buy back stock and have the stock go down. Now, companies obviously aren't like, we're going to buy back stock and think our stock is going to go down. That's not a thought that they have. But if you're buying your stock back at 20, 25, 30 times earnings, Apple, there could be issues with that use of capital. And I was going to say as well, the other issue with a company stopping stock buybacks is think about it. What causes stocks to go up? More people buying that stock. Right. Well, if you have this demand created from the company in the market to buy back stock, now you remove that demand. That's just one less source of demand to push your stock price higher. Now you need other forces to keep that stock moving higher. So it could be a problem if you're a company that's relying on stock buybacks and you choke that off. You could see a substantial decline in your stock price. Yeah,
and you brought up a good point too about it. Always check to see what they're paying for that stock buyback. Because I've seen over my 40 years of doing this, I see companies like, why are they buying that back? And then you find out they're buying the stock back at 100. Well, now the stock's at 50. What a terrible deal that was. I wish I had that dividend that they increased over that time frame. So be very careful of these stock buybacks. And again, we like them because it does give you bigger ownership of the company, but it may not always be the best thing to do depending on the company. And benefits of the stock buyback, so I will say, include the fact that there's no taxes for shareholders when they occur, and they do increase, as I said, the ownership of that business. Dividends, well, they can be taxed. They are tax favored. And depending on your tax bracket, one, you may pay very little tax, maybe no tax at all, depending on what your tax bracket is. And don't forget about the compounding effect of reinvesting those dividends into another investment, because we're not big on just buying back the stock, reinvesting dividends back in that stock, but we look at building the cash and say, well, great, now we got all this cash from dividends. Wow, here's a great buy we can buy because of all the dividends we got from the stock that compounds that dividend.
Yeah, and I want to be clear too. It was kind of an interesting proposition here. What's better? They're both good. I want to be clear. I'm not like, no, don't do stock buybacks. I like, obviously, when companies have that balance.
Right.
But if I had to choose one, it would definitely be a dividend. I think the dividend is again, far more beneficial long-term than the buyback. But, it's kind of an interesting proposition.
And what you have to do is your research. You have to look in. You can't, it's just, there's no flat rule. You have to look at all the factors we're talking about, see what is better for your personal situation or also the business that you're investing into.
And I want to be clear as well, we are value investors, so that is the number one priority. We do have a couple businesses in our portfolio that don't pay a dividend, and they actually do buybacks. So it's not like, oh, that's a terrible investment. The value is what comes first. The dividend, we always say, is like icing on the cake. And if I was running that company, I'd ask, can you please pay a dividend? But
and we do have companies that pay dividend and buy back some stock. So some do both.
Yeah, but I'm saying it's not like, oh, just because a company's not paying a dividend doesn't make it a bad investment.
Oh, yeah. Right.
Yeah. One thing, too, that is interesting about the current state of the market is it has become harder to find good quality companies. And if you listen to us, well, you know that we believe things are expensive. So that, in essence, has made it hard to find reasonably priced companies that pay good dividends. And I was pretty surprised by this, but looking at the S&P 500 index, the yield is now only 1.2%, which is near the all-time low that was hit during the dot-com bubble.
And if you look at the long-term history of the S&P 500, it's yielded generally around the 10-year Treasury. And I was surprised to learn up until about the 60s, the S&P 500 actually, and this kind of makes sense to me when you think about it, generally yielded more than the 10-year Treasury. Even looking back just 10 years ago, they're both yielding around 10%.
2%.
Oh, no, yes.
Not 10.
Oh,
that'd be a great investment.
Thank you for catching that. Yeah, 2%. I'm sorry, 2%. But currently the spread between the two is about 3%. So you got that big spread between how low the dividend yield is compared to the 10-year Treasury.
Yeah, and I mean, a lot of this has come from, I'm going to say, the increase in valuation on the S&P as it has seen its forward PE based on the next 12 months of earnings expand from 17 10 years ago to around 22 today. And again, could this be another warning sign that the S&P 500 index is overvalued? I mean, you look at the dividend yield, you look at the CAPE ratio, you look at the forward PE, you look at the current PE, the price to book, price to cash flow. I mean, we're at levels that are pushing historical norms. There's no valuation out there on the S&P 500 that's like, wow, this is like below historical standards or even near historical standards. So again, just another warning sign. We'll keep pushing that. Hey, I'd be cautious because I just don't know how you could have the S&P 500 continue to go from now 22 times up to 30 times. I mean, possible, but again, talking about a bubble continuing to climb and the collapse being more concerning, the higher that valuation goes, the more concern I'd say I have.
All this information does come from our Smart Investing newsletter. Go to our website, smartinvesting2000.com. Again, smartinvesting2000.com. Other topics you'll see are the solar panel loans. While they appear to be in trouble, that hurts private loans. One of the world's top bankers warns on private credit. Private equity should not be allowed in 401ks. That international trip is going to cost you more than you expected this year. Mined diamonds versus man-made diamonds. Which should you buy? And who has more viewers, Netflix or YouTube? We get so many good topics. I mean, people love the newsletter because there's so many good topics. Again, go to our website right in the middle of the page, smartinvesting2000.com. That's smartinvesting2000.com. Chase, let's jump right into our first company. You want to talk about Union Pacific first?
Let's do it.
All right. So Union Pacific, a lot of railroad stuff going on. They're in the industry of railroads, only 1% short on it, 83% institutional owned. PE ratio, 19.5, above the industry at 18.9. Price to sales, 5.6 versus 2.4. That's expensive. Price to book value, 8.3 versus 17.6. That's good. Price to cash flow, 13.7 versus 11.4. That's okay. Nice PEG ratio, though, 2.4 versus 12.1. You want a low PEG ratio there. Now, over the last year, the earnings for Union Pacific, they were up 4.3%, not as good as the industry growth at 10%. Sales for Union Pacific only up 0.4%, but the industry is only up 0.8%. The analysts do get a 5-year growth rate in the earnings of 8% above the industry at 5.7%. They do pay, talk about dividends, nice dividend, 2.5%. They only use 48% of their earnings to pay that out. Then the balance sheet, current ratio 0.7 versus 0.9. That's a little bit worrisome to me. And their debt's kind of high as well now, 2.1 versus 1.2. I know I helped this company years ago for years. Their balance sheet looked much better back then. I'm kind of disappointed here. Net profit margin is good at 27.8 versus 13.2. Wow, return on equity is 42 versus 17, and they got a lot of cash flow, free cash flow, $5.8 billion versus $2.4 billion for the industry. What do you got?
Well, it makes me wonder if the return on equity is that high. Generally, that can come from a lot of stock buybacks as you use that cash, and then all of a sudden it reduces the equity. But it's kind of curious, I guess, on what their stock buybacks have been over the years. Current price for Union Pacific, though, it is $224.74. 52-week range, the low here, $204.66. The high, $258.07. I see year-to-date, the stock is down about 1.5%, so not much movement there for Union Pacific on the year. Going forward for the company, we go out to December 2026. The estimated earnings per share of $12.99 unfortunately gives us a target sell of just $215.63. And I was excited about this because the stock pulled back a little bit. They are now, I guess, in advanced talks to potentially acquire Norfolk Southern, another railroad company. And generally with those conversations, the acquiring company will get hit a little bit because of concerns over maybe integration costs, what debt would be needed. And with this company already having a weak balance sheet, I'd be definitely concerned.
Yeah, and I want to buy this company as well. It's a type that we like. I mean, AI is not going to change it. AI would only improve probably their operations. But again, it's like the market. It's expensive. And this is not how you make money investing, by paying up for these companies. It's a great business, but you said how much growth you get, like 10% or something from the target sell price?
No, it's above the...
Oh, but the current price is above the target sell price. Oh, that's even worse. I thought.
And I think the concept of buying is interesting. I mean, right now Union Pacific has a dominant position in the western 2/3 of the U.S., and Norfolk Southern really focuses on the eastern states. Mm-hmm. So, I mean, that would be a way to kind of create this nationwide railroad. But then you have to have questions around regulatory approval. And there was actually a regulatory approval in 2023 for another merger between Canadian Pacific and Kansas City Southern. That created one from Canada to the United States to Mexico. So, I mean, it's definitely possible, but I don't think it's worth the regulatory risk. I don't think it's worth the balance sheet risk. And clearly the valuations don't look good either.
I guess we'd call this a sell.
Yeah.
All right. When we come back, we got companies talking about is TOST, American Eagle, and Abbot Labs. Stay with us. We'll be right back after this break. Alrighty, welcome back to Smart Investing Show. This is the part now we talk about financial planning. For that, we have Harrison Johnson, our CFP, show up here and talk about financial planning. And Harrison, I am so excited about this. I see new tax rules for tips and overtime. Does this mean I can get free overtime? I'll pay less taxes. Is that going to help me?
Well, you don't get overtime, so or tips.
Nothing ever helps me. Nothing. All right, what do we got?
So with the tax bill that passed a couple weeks ago, part of it was this conversation on no tax on tips or overtime. So what it is this applies from right now, starting January 1st of 2025, and then going through 2028, so 4 tax years, up to $25,000 of tip income or $12,500 of overtime income can be excluded from federal income taxes. And there's an AGI limit on that. It starts to phase out at $150,000 of income if you're single, or $300,000 of income if you're married. So that's what we've heard in a nutshell, but we've got some details that we can get into it. So on the tip side, kind of what you're just talking about, Brent, is tips have to be customary in that line of work for you to actually deduct it. So we can't go in and call our income tip income and have it be tax-free. So it's for people who customarily get paid tips, like hairdressers or bartenders or servers or things like that. So that's the thing on the tip. And then there's some caveats in the overtime part of it that I think is really interesting. So again, it's $12,500 of overtime, but the way that it works is the tax-free portion of it is only the actual premium you get on your overtime. So for example, overtime might be time and a half. So if you make $20 an hour, then your overtime pay is $30 an hour. The tax-free portion is only that extra $10 that you get, not the full, income that you have that's actually overtime.
I think myself and many other people thought the whole thing was going to be tax-free, but you're saying, you better say it again, because
that's a huge part of it. And there's also another big part of it as well. But again, the tax-free portion is only the actual overtime part of it. So again, if you make $20 an hour and your overtime pay is $30 an hour, only that extra $10 is actually tax-free. That $20 that you get is still taxable on all levels. The second part of it is this is a federal law. In California, there's a lot of different ways to qualify for overtime. Working more than 8 hours in a day, working 12 hours in a day, working 7 days in a row. But the overtime, for it to be considered tax-free on the federal side, the definition is if you work more than 40 hours a week, only that is overtime. So working more than 8 hours in a day, if you're not over 40 hours in the week, then it's not tax-free.
That's very helpful, because I was thinking what could happen is, as an employee, like they leave early one day.
Mm-hmm.
They leave, I don't work 6 hours a day. Come back the next day, well, I'm going to work 10 hours and get paid overtime. But you can't do that. It's got to be 40 hours for the whole week.
Correct. Now, as the employer, so you're an employer,
right.
So if employees did that, the employer is still responsible, if you're in California, to pay that overtime, but the employee then would not receive it tax-free unless, again, it's, they have to work more than 40 hours in a week for those extra hours to be tax-free, and it's only the premium that they get in addition to the regular hourly wage for it to be tax-free.
And for the employer, this really doesn't hurt the employer, because they still get the same deduction for
it.
it.
Yeah. So the employer doesn't notice anything different. W-2s are probably going to be looking a little bit different, but that's more of a payroll thing. And then employees who have tips or overtime, I think it's going to be something that they file on their tax return to say, this is the amount of the overtime I had, or this is the amount of tip income I have. And it's almost like an above the line deduction on their own personal tax return. So for the employer, whatever you pay your employees, payroll taxes, wages, all that still is deductible the same way. So this is only influencing employees. But again, it's not like all your tip income is now tax-free, all of your overtime is now tax-free. It's got to fall in these parameters. And in addition to that, this is only a federal thing. So you're still paying state income taxes, you're still paying Social Security taxes, Medicare taxes. In California, we have disability taxes, so all that still applies. It's just federal income taxes on certain overtime, and if you're actually qualified to get tip income.
We talked about this last week with the one big beautiful bill, and some of my concerns is so many hands in the pot. It really kind of starts to, I think, reduce the intended benefit. And my concern here is this is just so complicated. Who is going to have to be the one that deciphers what is actually going to be tax-free? Because if you have on your W-2, let's say, right, where it says overtime pay in California, your overtime pay, I believe when we produce our W-2s or we produce our, weekly paychecks, pay stubs for people, it just says overtime pay. Regardless of if it was 40 hours a week or 42 hours a week, if somebody worked more than 8 hours a day, it still shows up as overtime pay. Who then is going to go through and be like, oh, no, that week they worked 10 hours that day, but they didn't hit the 40 hours that week. They only hit, 38 hours that week, even though it says overtime pay. That isn't necessarily constituted as that tax-free portion. Who's going to do that?
QuickBooks. I don't know.
I mean, this legislation is so complicated that I don't know how in the world we're going to actually be able to decipher what is going to be eligible for these tax benefits, especially in a state like California. If your state law differs from the federal law, good luck.
Yeah, it's going to be interesting because, right now, the state of California says if they work over this amount of time, it's overtime. You get time and a half and then up to double time, depending on, how many hours in a day and everything. But all of that is included in, your box one on your W-2 and wages and, W-2 compensation. So now there has to be a separate little carve out where okay, well, you got paid that, but then of that, how much is considered overtime as, is according to Section 7 of the Fair Labor Standards Act. So there has to be, broken out in that way. And it's really kind of interesting because this is active right now. So as of 2025, so, payroll providers, I'm sure, are scrambling to figure out how they can handle this, especially for income that's already been paid for the first 6 months of the year.
I mean, my concern here is I think the benefits that were produced by all this complexity is so small, and it comes potentially at the cost of, raising the debt, raising the deficit. And I don't know if the benefits, since they're so complicated, are going to long-term be worth it. I mean, we'll have to, I guess, see, but I definitely have my concerns around the complexities here.
It's complex, and I think part of it, too, is, this was really in the campaign trail. No taxes on Social Security, tips, overtime, and then looking at the details, it's not quite as straightforward as maybe a lot of people were hoping for.
Yeah, I think it's one of those things. It's good, but not as good as you expected,
Yeah.
as you heard. And you kind of break it down for people. And again, I mean, you're still getting some money tax-free.
Yeah, taxes are not increasing.
Yeah,
It's
not
just
increasing.
you're
And again, if you work more overtime, it's just, you will get some tax benefits on.
Not if you don't know how to file properly because it's so complicated.
yeah, I'm not sure how difficult it's actually going to be. We'll see. I'm hoping it's not that difficult.
I'm sure that the payroll providers might have to carve out like overtime,
Right.
qualified federal overtime.
I think that's what it's
going to
be.
fall on them, and I think
it's
that's
going to
be rough.
Yeah, they're going to have a separate box to say, okay, you made $60,000, but then an extra $5,000 of it was overtime, subject to those rules. So that's deductible on your taxes,
It's
essentially.
going to be very, very tough for the small business. Has maybe one employee, they do the payroll themselves. They got to get QuickBooks. They got to do something because there's so many rooms for error, it sounds like.
Oh, yeah. So, we'll see how it shakes out. But those are the rules.
Okay.
It's not, as simple as we thought. I was reading this. I was like, oh, wow, this is a little bit more complicated than I thought it would be.
All right, Harrison, next week your goal is to come back with something for me that I can save taxes on.
Well, you're gone, so.
Oh, okay. Well, I guess you're off the
So,
hook.
I'll see you next week. Yeah.
Well, Harrison, thank you very much. That's great information
guys.
as usual. All righty. Again, that's Harrison Johnson. He is our CFP, our financial planner. He's a fee-based planner here at Wilsey Asset Management. He doesn't try to sell you annuities or life insurance. Really sits down, very knowledgeable guy. You hear him every week here on the show talking about different things. You want a free consultation with him, give him a call at the office, 858-224-0004. Again, it's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. And if you have a financial planner now, I encourage you to give him a call, sit down, and compare your financial plan to what his financial plan is. I'm very confident you're going to say, like, wow, he's doing things that my guy didn't even think about.
Yeah, no, it's very in-depth, very thorough, and, I think a lot of people that work with him really, really enjoy it.
Yeah, and he's very, very knowledgeable. I mean, he spends, and here's an example. You go to a guy that manages your money, and he's a financial planner. He's got to spend time understanding financial planning and the investments, and we spend all our time doing the investment part. Harrison, he just spends all his time on financial planning, taxes, estate planning, all this other things. He doesn't have to worry about the investment part because that's what we do. So that's why that's the advantage that we have. And he's here at Wilsey Asset Management. It's a fee-based planner, so it's not going to be any commissions or anything of that nature. All right, should we talk about companies here? Talk about employers. TOST might be the one to. Oh no, are they just a billing service or are they a payroll service? What does TOST do?
It's kind of a suite of products, I would say, and it focuses on the restaurant space. I mean, I kind of had it pulled up in terms of their outline, but it operates a cloud-based digital tech platform for the restaurant industry. I mean, it includes kind of point of. I think a POS system, obviously, like when you go to restaurants, the waiter will come by and you pay on the little thing now, the digital thing. Also, too, it looks like payroll, some back office tools for restaurants, some financial technology, ingredient price tracking. So I think they have this bundle where they really have focused on the restaurant industry. So, I mean, interesting business, but obviously, I don't know if that makes it a good investment. We'll have to find that out.
I always feel, and I kind of like the TOST. They come by, they put your credit card in, boom, boom. I just always feel like I'm missing something where they need to take the credit card, come back and get a sign up, or do my tip. Sometimes I feel pressured on the Toast thing.
Well, especially how they're standing there, and some of them will kind of look away, and then
Look over your
I'm
shoulder,
not
like,
looking.
What,
Yeah.
you only hit the 10% tip? I think it is a good thing overall for businesses. But let's say it's a good investment here. They are in the software infrastructure industry. 6.6% shares float. Not bad, but I'm surprised it's even that high. 94% institutional owned. Not a good start, unfortunately, on the PE ratio, 180 versus 52. So the software industry is a high software infrastructure is the industry is a high PE industry at 52.7. Price of sales 5.6 versus 11.3. Price of book value 16.8 versus 11.9, and price of cash flow checks in at 64.1 versus 32.5. So that's pretty expensive there. So I don't like seeing that. No earnings growth over the last year. The industry was up 1.7%. Now sales are doing very well for Toast. They're up 19.1%. Industry was down 2.2%. Not good here. And usually I see the opposite. The 5-year earnings per share growth estimate from the analysts is a negative 14.8% for Toast versus a positive 12.4%. And I thought that'd be on the other side, but I think they might be losing a lot of money now and continue to lose money. We'll see as we get through the numbers here. They do not pay a dividend. Look in the balance sheet, a lot of liquidity. Current ratio 2.5 versus 2. That's a positive. Here's another positive. No debt on the balance sheet, so they can lose money for a while and not have to worry about going bankrupt. We do see a net profit margin of only 3% versus 22%. That's disappointing. Return on equity is 9.4 versus 30.3. Free cash flow, well, here's a problem as well. $408 million. The industries have $42 billion. So again, I know this is a pretty new company. Maybe you had that information. It just doesn't seem to be where I would hope it to be at this point in time.
Yeah, I think I'm going to say an unfair comparison to the software industry, especially if you're looking at just free cash flow. I mean, if it's a smaller business compared to other businesses, their free cash flow, of course, is going to be smaller than, I'm trying to think of a large, maybe an Adobe, right? Adobe is a pretty big company. So I don't know if I necessarily would say that in and of itself is concerning. I mean, it is I'm going to say a newish business. Looks like it was incorporated back in 2011. So, 14 years is relatively new in, obviously, the business landscape. But looking at the returns here, this is interesting. Current price for Toast, again, their ticker symbol is TOST. It's $48.70. The 52-week range, the low, $22.10 in the high, which was achieved on Friday, $49.20. Year to date, the stock's done well. Year to date, it's up 33%, but over the last 1 year, this is where it's interesting, up 95%. So, the stock's done very, very well over the last year, but I didn't know this. I was like, wow, it must be a good long-term return, right? Actually, in 2021, the stock hit an all-time high of $69.93. So, it definitely fell with all the buzz that kind of was created in 2021 and then busted in 2022. This was part of that hype that occurred, and we're still, again, about $20 short of that all-time high. Looking forward for the company, though, it's expensive. December 2026, I see estimated earnings per share of $1.18. It gives us a target sell price of $19.59. Trades for over 40 times earnings. It's an expensive stock, to say the least.
Yeah, I was kind of hoping for something kind of exciting there and didn't quite get it because I do like the concept. I think it's a growing concept. It's a growth business, which we don't invest in growth businesses because, as we've talked about many times, it can change very quickly and that growth goes away and all of a sudden you have nothing on the company.
My concern with a business like this, too, is if the economy slows, I think this company would get hit very hard. Because if the economy slows, that means restaurants are probably one of the first places to get hit. And I don't know enough about Toast's business model, but I'd have to assume they can grow one of two ways. Get more restaurant clients, or the particular restaurants that they're in see increasing sales. Well, if you have a slowing economy, a difficult economy, restaurants start going bankrupt, they start closing, well, you lose customers. People start eating out less. Well, now you're losing revenue. I would assume they get some cut of the profit from, increasing sales. So, this could be a company that in a slowing economy would just get absolutely crushed.
Yeah, and it's something that...
Not that I see that occurring.
No, but if that were to happen, that's a risk you want to know about. And do you know if they get paid like a percent of what they bring
I'd
in?
have to assume. If you're looking at like a PayPal or you're looking at a Square, right, they take a percentage of any transaction that occurs. I'd have to assume TOST is very similar. When you go and you tap your credit card, I'm sure they get a percentage of that.
Interesting. Well, let's talk about clothing. Let's talk about American Eagle. And I helped this company years ago. Remember, got a great dividend. We did okay on it, but it just seemed to get stuck for a while. So I'm kind of curious to look at this one. Maybe now it's a buy again. Company again is American Eagle Outfitters, symbol AEO in the apparel retail industry, which, by the way, is a very volatile industry because you can be the hot one this year. Next year, your designs came out. Nope, nobody wanted them, and you go down dramatically. They are in the industry of apparel retail. Short on the float is 18.9%. Gee, where are those meme buyers there?
They came.
They did come to American Eagle?
Yeah.
Oh, okay. Oh, that's right. That's why we're talking about this one. What am I thinking? I totally forgot. Okay, they're there. Okay, let's talk more about that in a minute. We do see a PE ratio is 12 versus 24.7. That's a positive. Price of sales 0.4 versus 2.1. Price of book value 1.4 versus 6.3. And we see price of cash flows only 4.9 versus 16. So no PEG ratio, but those valuation ratios look pretty attractive. Now, over the last year, the earnings are down 11.7%. The industry is up 9%. Sales for American Eagle, well, they were down 0.9% when the industry was up 6.7%. Analysts don't like American Eagle for the next 5 years. They're looking for earnings growth or decline of 52.5%. But the industry seems to be in trouble as well, down 74.1 is the estimate on the earnings going forward from the analysts. Now, they still pay a nice dividend here, 4.3% a yield, payout ratio very attractive, 49.5, so that's a positive there. Take a look at the balance sheet. Current ratio is 1.4 versus 1.7. That's okay. Debt to equity is just at our upper limit. It's about 1.2 versus 0.9, but I'm okay with a 1.2 debt to equity. We do see a net profit margin of 3.7 versus 8.4. Return on equity is 13.3 versus 34. Free cash flow could be a problem here. It's only $212 million. The industry is at $3.3 billion. Chase, what do you got?
Yeah, so current price here for American Eagle, again, their ticker symbol is AEO. It's $11.74 and 52-week range for this company. The low here, $9.27 and the high, $22.83. Over the last year, I mean, it's been crushed, down about 44%. It's interesting, 5-year returns about 22%. And I kind of look at Abercrombie & Fitch as the primary competitor to American Eagle. 5-year return for Abercrombie & Fitch, 852%. So...
Ooh.
They've definitely gone different routes in terms of their stock
Did you see the
performance.
10-year return for American Eagle?
I did not. I'll let you give that.
Yeah, I show a negative 12.9%.
Interesting.
Yeah.
And that includes dividends, I believe.
Yeah.
So, yeah, American Eagle now has a market cap of about $1.95 billion, where Abercrombie & Fitch is actually, about $5-ish billion, or $4.5 billion is where that's actually at. So definitely smaller than Abercrombie & Fitch. But going forward, I mean, this looks interesting. I'll tell you why. I mean, you go out to January 2027, estimated earnings per share of $1.18 gives you a target sell price here of $19.59. The stock trades for under 10 times earnings. And this kind of got lumped in with meme stocks, and I don't really know if it necessarily was. The media said it was. But this seems like it's different than your normal meme stocks. This one has earnings. It's a decent-sized company, still around $2 billion. The only thing that was announced was, I think her name's Sydney Sweeney. She kind of grew to fame in a show called Euphoria. Mm-hmm. She came out with, I guess, they're doing an ad campaign, and the stock popped 18%. And obviously this last week we saw the meme craziness with Kohl's, Open Door, GoPro, Krispy Kreme. And this kind of is like, oh, it's a meme stock. I'm like, is it though? Or is it just they kind of popped on some over short interest, and then this announcement with Sydney Sweeney? I wouldn't lump this in with the other meme stocks, to be honest.
Well, I mean, you can call it a meme stock, but it's a good one because you actually have something there versus the other meme stocks generally losing money, ton of debt, and so forth. This would be one. And again, the meme stocks come in, or the meme, what do you call them, players, whatever you want to call them. They come in to buy the stock like crazy. It drives it up. Now, the only problem I can see with them, or why it went down so much, was 90 days ago the earnings were expected by the analysts to be $1.57, and you said now they're $1.18. That's a decline of 25%. Why are those earnings dropping so much? What is going on with this
Tariffs?
business?
Maybe speculating.
Okay, I was going to say if you knew that or not, but yeah, that very well could be. But that's a big hit, and we've talked about this with the tariffs. that we believe that you will see earnings lower for companies, but that's a pretty big decline on their earnings for them. And maybe they get a lot from China.
Yeah, potentially. I mean, I'm not sure. I'm speculating here. It's definitely something that you'd have to look into. But I mean, if I was a meme stock trader and this was a meme stock, this would be one of my favorite meme stocks, I'd have to say. And one thing I'll kind of point out with the meme stocks that I think is so funny is this past week when you watch it, it's like there'd be one day where one meme stock was hot, and then the next day another one, and that one that was hot the prior day, that one would fall dramatically, and it's like everybody's kind of chasing them around. And I think Kohl's, at one point, they went as high as like $22 a share, and then that same day they fell like 50% from the high. I mean, it's just crazy why anybody does this. This is pure gambling. It's not investing to do meme stocks. It is pure gambling because they are all over the place. And what concerns when you talk about the overvaluations and the craziness in the market, this is just another thing that kind of points to that. And remember, the last time we saw meme stocks was 2021, and 2022 was a very difficult year.
Yeah,
so
that's true.
Again, be cautious.
I think we say that every show. Be cautious, be cautious. It doesn't mean you can't invest. Just be careful what you invest in because there's a lot of things pricey, and you don't go to the store and buy the highest price thing. You try to buy things on sale. So let's move to a drug company, Abbot Labs, symbol ABT. They're medical devices. So they're not a drug company. They're actually a device maker.
They do a bunch of different things. I know they do
drugs too.
I think they do drugs. They do infant formula. So, I mean, they have, it looks like products. It looks like they do have hormone replacement therapy, generic pharmaceuticals. So it looks like, okay, here it is. Established pharmaceutical products, diagnostic products, nutritional products, and then medical devices. So they kind of run the gambit there in the healthcare industry.
Maybe they get the most from medical devices. That's why they're put into this industry, maybe.
Potentially, yeah.
We do see they have not a bad PE, 15.9 versus 38.5 for the industry. Price of sales, 5.1 versus 3.9. That's obviously not good. You want your valuation ratios lower than the industry average. Price to tangible book value, 11.5 versus 35. That's a positive. But price to cash flow is 24.7 versus 28.2. So I'd call that about the same. So it's okay. PEG ratio, 3.6 versus 1.9. That is not good. You want your PEG ratio lower than the industry average, and 3.6 versus 1.9 is saying you're going to pay a lot for the growth going forward. Now, and I think a lot of this comes from, I think you said they have the diet drugs. Earnings over the last year are up 143%, but the industry's up 116%.
No diet drugs. No.
No diet drugs? I thought you said that diet drugs.
No, I didn't say diet drugs.
Okay, well, that's pretty interesting where they're getting that from.
Yeah.
Okay.
I don't think it's infant formula because people aren't having babies at the same rate.
I thought I heard you say GLP-1 or whatever. No. So, well, that's good then. So they're doing something right here to grow the earnings. Sales up 4% versus 11.6 for the industry. 5-year growth rate is a 6.5 versus 11.2. They pay a dividend, like a normal size dividend, 1.9%. Only use 29% of their earnings to pay that out. And then look at the balance sheet. Current ratio, 1.8 versus 2.2. We do see a net profit margin, very good, 31.9 versus 9.9. Return on equity, 27.7 versus 18. Free cash flow, $6.6 billion, twice the industry at $3 billion. So I'm kind of liking what I see here, depending on what you say. This could be something worth maybe getting into.
Yeah, current price here for Abbott Laboratories, again, their ticker symbol is ABT, to $126.54. 52-week range, the low here $99.92, the high $141.23. I thought the stock was interesting because they actually slid about 8% after they reported a quarter where they beat on both sales and earnings.
And they fell.
But it was their guidance was for $1.28 to $1.32 for earnings per share versus the estimate of $1.34. So I kind of like when you see companies like that where they have a good quarter, but maybe they just miss guidance slightly and the stock falls. You can sometimes find some great deals. But I'm saying, unfortunately, you go out to December 2026 for this company and see estimated earnings per share here of $5.67. Gives a target sell of $94.12. So
where's the stock at now?
$126.54. So it's trading at, over 22 times those future earnings.
Another sell.
Another sell, yeah.
Yeah. And again, we say another sell because we are conservative. We use an estimate of 16.6 times forward earnings, which is about the average. We're not trying to take the most out of a company. We're saying let's buy it on sale and sell at a reasonable price. And right now, there's a lot of things that are not at reasonable prices. And this is when the investor can get burned.
Who would have thought at the beginning of the show that the most intriguing company that could warrant research would actually be one that was lumped in with the meme stocks in American Eagle?
Yeah. I mean, it's just, and again, it is amazing when you look at that compared to, I think you said Abercrombie and Fitch, the big differences. And I mean, we're not in that area because I think the teen retailers is what they're at. So,
I don't go shopping at either location at this point.
and I remember we bought Abercrombie years ago. We bought it 25. I think we sold it 75. Made a lot of money from it. But with it now, I know nothing about that company. American Eagle, can they replicate what Abercrombie does? What's the difference?
I don't know. I mean, it could just be perception. It could be actual business. I mean, you're chasing trends is the problem.
Yeah, that's the research people have to do. That's what we would do if we're going to buy it. All right, there's a closing bell. Thank you for listening to the Smart Investing Show. It is for informational purpose only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Thanks for listening. We'll be back next week right here on the Smart Investing Show.